Right now, in Europe, there are 3 working-age people for every retiree. 3 people working, paying taxes, funding pensions, supporting healthcare, keeping the system running for 1 person who's retired. That ratio has held for decades. It's the foundation of Europe's entire social model. Universal healthcare, generous pensions, early retirement. All of it depends on enough workers paying into the system to support those who've left it. But by 20, 40, 15 years from now, that ratio changes. 3 workers per retiree becomes 2 workers per retiree. And by 2050, in some countries, it approaches 1 to 1. 1 worker supporting 1 retiree. That's not a policy problem. That's not a recession you recover from. That's mathematical collapse. Because when the number of people receiving benefits exceeds the number of people funding those benefits, the system doesn't bend. It breaks. And here's what nobody wants to say out loud. Europe has already crossed the point of no return. The fertility rate across the EU is 1.53 children per woman. You need 2.1 just to maintain population. They're not even close. The people who will be working in 2040 have already been born. The people who will be retiring in 2040 are already in the workforce. The math is locked in, and the math says Europe's economic model is ending. Before we show you how this plays out, you need to understand what's happening right now on the surface. Because the demographic crisis isn't theoretical. It's already crushing Europe's economy. Germany, the 4th largest economy in the world, the industrial powerhouse, the country that bailed out half of Europe during the debt crisis. In 2025, Germany's economy grew 0.2%. Not 2%, 0.2%. After 2 consecutive years of economic contraction, Germany is essentially stagnant. France grew 0.6%. Italy, 0.4%. The entire Eurozone averaged 1.1% to 1.3% growth. For comparison, the United States grew 2.5%. China grew 4.8%. Europe isn't just growing slowly. It's being left behind. And this isn't a recession. Recessions end. This is structural. This is what an economy looks like when the workforce starts disappearing. When you don't have enough young workers entering the labor market to replace those retiring. When your most productive companies can't find employees. When tax revenues stagnate because the tax base is shrinking. When every year there are fewer people working and more people drawing benefits. That's not a business cycle. That's demographic decline. And demographic decline doesn't reverse quickly. It takes generations. Let me show you the mechanism. Europe's social model was built in the 1950s and 1960s. Post-war reconstruction, rising prosperity, and a demographic structure that made it all possible. In 1960, the average European woman had 2.6 children. The population was young, the workforce was growing, and governments designed a system where current workers pay for current retirees. It's called a pay-as-you-go system. You work, you pay taxes. Those taxes fund pensions and healthcare for people who are retired. And when you retire, the next generation of workers pays for you. It works perfectly, as long as the ratio stays stable, as long as there are always more workers than retirees. But Europe's fertility rate started falling in the 1970s. By 1990, it was 1.8 children per woman. By 2000, 1.5. Today, 1.53. That's 28% below replacement level. And it's been below replacement for over 30 years. Which means for 3 decades, each generation born has been smaller than the one before it. The consequences compound. Fewer children today means fewer workers in 20 years. Fewer workers in 20 years means fewer taxpayers to fund the system. And fewer taxpayers means the burden on each remaining worker increases. It's a spiral. And Europe is deep into it. Here are the numbers. Right now, the EU has about 450 million people. About 20% are over 65. That's 90 million retirees. The working age population, people aged 20 to 64, is about 270 million. That gives you the 3-to-1 ratio, 3 workers per retiree. But by 2050, the over 6'5" population will be 130 million, nearly one-third of the total population. The working age population will shrink to 240 million. That's 2 workers per retiree if you're lucky. In some countries, it's worse. Italy already has 29% of its population over 60. By 2050, it'll be over 40%. Germany's working age population is projected to decline by 15%. Spain, despite being one of the faster-growing economies right now, has a fertility rate of 1.2. 1.2. That's catastrophic. And here's the critical point. These projections assume continued immigration. If immigration slows or stops, the numbers get far worse. 22 out of 27 EU countries will see their working age population decline by 2050. The only countries projected to grow are those with high immigration: Sweden, Ireland, Luxembourg. Everyone else shrinks. And shrinking workforces mean shrinking economies. Now, let me show you why this is different from a normal economic crisis. In a recession, demand falls. Businesses cut back. Unemployment rises. But the workforce is still there. When the economy recovers, you hire people back. Growth returns. The system rebounds. But demographic decline is different. The workers don't exist. You can't hire people who weren't born. You can't stimulate demand when there aren't enough consumers. You can't grow an economy when the labor force is shrinking. And most importantly, you can't fund a pay-as-you-go pension system when there aren't enough workers to pay into it. The math breaks. Right now, Europe's governments spend about 10% to 13% of GDP on pensions. In Italy, it's over 15%. That's sustainable when you have 3 workers per retiree. Each worker's contribution, combined with employer taxes, covers the cost. But when you drop to 2 workers per retiree, the math changes. Now each worker has to pay 50% more to cover the same benefits, or you cut benefits, or you raise the retirement age, or you go into debt to cover the gap. And Europe is already in debt. The EU's average debt to GDP ratio is 82%. In the Eurozone, it's 89%. 5 countries are over 100%. Italy is at 140%. Greece, 160%. When you're already heavily indebted and your workforce starts shrinking, you can't borrow your way out. Because lenders look at your ability to repay. And your ability to repay depends on future tax revenues. And future tax revenues depend on having a growing, productive workforce, which Europe doesn't have. This is the demographic trap. Once fertility falls below replacement and stays there for decades, you enter a cycle that's very difficult to escape. Fewer children means fewer future workers. Fewer future workers means lower future economic growth. Lower economic growth means lower wages and higher uncertainty. Higher uncertainty makes people delay having children, which keeps fertility low, which perpetuates the cycle. Japan fell into this trap in the 1990s. 35 years later, they still haven't escaped it. Japan's fertility rate is 1.2. Their population peaked in 2008 and has been declining ever since. Their economy has barely grown for 3 decades. And despite every policy intervention, every attempt to raise the birth rate, nothing has worked. Because once a society adapts to low fertility, once the expectation becomes 1 child or no children, reversing it is almost impossible. Europe is now following the same path. And the thing that should terrify European policymakers is that Japan had one advantage. Europe doesn't. Japan is ethnically homogeneous, with tight immigration controls. Europe isn't. Europe has been relying on immigration to offset demographic decline. But immigration is politically contentious. It creates social tension. It fuels populist movements. And even with immigration, it's not enough. To maintain the current worker-to-retiree ratio through 2050, the EU would need over 100 million immigrants. 100 million. That's not realistic. That's not politically feasible. And even if it were, Integrating that many people into the workforce, ensuring they're productive, ensuring they pay taxes rather than draw benefits, that's an enormous challenge. Now, let's look at what's already happening because of this. Germany, Europe's largest economy, is stagnating. 0.2% growth in 2025. Why? The manufacturing sector is struggling. Exports are falling. Competitiveness is declining. But underneath all of that is a workforce problem. German companies can't find workers. The unemployment rate is 3.6%. That's near full employment. But it's not a sign of strength. It's a sign that there aren't enough people. Companies want to expand but can't hire. Factories want to increase production but lack workers. The economy is constrained not by demand, not by capital, but by labor. And it's getting worse. Germany's working-age population is projected to decline 15% by 2050. That's roughly 10 million fewer workers. 10 million. You can't replace that with automation. You can't replace that with productivity gains. That's a structural reduction in economic capacity. France has the same problem. Italy, worse. Spain, even worse. The countries that should be driving European growth are all demographically constrained. The only bright spot is Spain, growing at 2.9% in 2025. But Spain's growth is driven by tourism and temporary factors. Their fertility rate is 1.2, the second lowest in Europe. The growth won't last. And here's where the crisis accelerates. Aging populations don't just shrink the workforce, they change consumption patterns. Retirees spend less than workers. They've already bought their homes. They're not raising children. They're not investing in the future. They're managing fixed incomes. And as a larger share of the population shifts into retirement, aggregate demand falls. Businesses see weaker sales. Investment declines. Growth slows further. It's a feedback loop. Japan experienced this in the 1990s and 2000s. Falling demand, falling investment, falling growth, deflation. They called it the lost decades. Europe is entering the same cycle. And once you're in it, escape is extremely difficult. Because the policies that normally stimulate growth don't work. You cut interest rates. Already done. The ECB has had rates near zero for years. You increase government spending. Already constrained by debt levels. You try to boost productivity. Productivity growth has been stagnant since 2008. You encourage immigration. Politically toxic and insufficient anyway. There's no policy lever that solves demographic decline quickly. The only real solution is raising the fertility rate. And that takes decades to show results, even if you succeed. Here's what European governments have tried. France offers generous family benefits, childcare subsidies, parental leave, tax breaks for large families. And France has the highest fertility rate in Europe at 1.84, still below replacement. Germany offers similar benefits, fertility rate 1.5. Sweden, known for family-friendly policies, 1.7. The policies help at the margin, but they don't reverse the trend, because the decision to have children isn't just economic. It's cultural. It's about career expectations, housing costs, lifestyle preferences, uncertainty about the future. In modern, wealthy societies, fertility rates have been falling everywhere. South Korea, 0.7. Japan, 1.2. China, 1. Italy, 1.2. Spain, 1.2. The pattern is universal, and no country has figured out how to reverse it. Which means Europe is facing a future that's already locked in. The children who will be working in 2040 have already been born. You can't change that number now. The people who will be retiring in 2040 are already in the workforce. You can't change that either. The worker-to-retiree ratio is going to fall from 3:1 to 2:1. The only question is, what happens when it does? Let me show you the options. Option 1. Cut benefits. Reduce pensions. Raise the retirement age. Means test healthcare. Make the system affordable by reducing what it provides. This is politically explosive. Retirees vote. They're organized. They're politically powerful. Any government that tries to cut pensions faces massive backlash. And in democracies, voters can punish politicians who make their lives worse, so this option is difficult. Option 2. Raise taxes. Increase contributions from workers to cover the higher costs. The problem is, workers are already highly taxed in Europe. In France, the tax burden is 46% of GDP. In Germany, 39%. In Italy, 43%. There's not much room to go higher without crushing economic activity, and young workers are already leaving. Brain drain is real. Skilled professionals move to the US, Canada, Australia, where taxes are lower and opportunities better. Raising taxes accelerates that flight. Option 3. Immigration. Bring in workers from outside Europe to fill the gap. This works economically, but creates social and political tension. Europe's immigration debates have been divisive for years. And, as mentioned, you'd need over 100 million immigrants to maintain current ratios. That's not happening. Option 4. Go into debt. Borrow to cover the gap between revenues and obligations. Keep the system running by accumulating more debt. This is what most countries will do. It's the path of least resistance, but it has limits. When debt levels get too high, bond markets revolt. Interest rates spike. Debt service consumes more of the budget, and eventually, you reach a point where the debt is unpayable. Greece hit that point in 2010. It required an EU bailout. If Italy or Spain hit that point, there's no one big enough to bail them out. Option 5. Economic collapse. If you can't cut benefits, can't raise taxes, can't bring in enough immigrants, and can't borrow indefinitely, the system breaks. Pensions get cut by default. Healthcare degrades. Services collapse. Social unrest follows. This is the scenario no one wants to talk about. But it's possible, and demographic math makes it increasingly likely. Now let me show you what happened when another advanced economy faced this exact crisis. Japan. In 1990, Japan was an economic superpower. The Nikkei was at all-time highs. Real estate prices were astronomical, and the Japanese model was admired globally. Then, the bubble burst, and Japan entered what became known as the lost decades, 35 years of stagnation. But the bubble bursting wasn't the only problem. Japan's demographics were collapsing. Fertility rate fell to 1.5 inches 1,995, then 1.3 inches 2003. The population peaked in 2008 and has been declining since. The working-age population started shrinking in the 1990s, and the economy never recovered. From 1990 to 2020, Japan's GDP grew less than 15% total. Over 30 years. The Nikkei didn't return to its 1,989 peak until 2024. 35 years. Real wages fell. Deflation set in. Government debt exploded to over 250% of GDP. And despite near-zero interest rates, quantitative easing, massive fiscal stimulus, nothing worked. Because you can't stimulate an economy when the workforce is shrinking and the population is aging. The demographics override the policy. And here's the lesson for Europe. Japan's experience shows that once you're in a demographic trap, escape takes decades. Japan started addressing the problem in the 1990s. 30 years later, they still haven't solved it. And Japan had advantages Europe doesn't. Japan is a unified country with a strong national identity. Europe is 27 countries with different languages, cultures, and political systems. Coordinating policy across the EU is difficult. And many of the countries most affected, Italy, Spain, Greece, are already dealing with high debt and weak institutions. They're less equipped to handle the crisis than Japan was. So what does this mean for wealth? Because that's the question everyone in Europe should be asking. If the economic model is breaking, if growth is stagnating, if the debt is rising, what happens to savings? What happens to pensions? What happens to property values? History gives us some answers. Japan's experience is instructive. Japanese stocks went nowhere for 35 years. Real estate fell 70% and never recovered. Japanese government bonds paid near zero interest. Anyone who stayed in Japanese assets from 1990 to 2020 saw minimal returns or losses, but anyone who diversified internationally did fine. The S&P 500 went from 330,990 to over 4,000 by 2020, a 12-fold increase while the Nikkei was flat. The lesson is clear. When your home economy is in structural decline, holding only domestic assets is a losing strategy. You need international exposure. And here's what's happening in Europe right now. Capital is already leaving. Wealthy Europeans are buying property in the US, UK, and Asia. They're opening foreign bank accounts. They're moving money into dollar and Swiss franc assets. They're buying gold because they understand what the math says. European government bonds are going to underperform. European stocks will struggle in a low-growth environment. European real estate will stagnate or decline in many regions as populations shrink. The safest strategy is diversification. Hold assets outside Europe, in currencies that aren't facing the same demographic crisis, in economies that are still growing. And there's another factor: currency risk. The euro has been relatively stable, but that's because the ECB has been aggressive with monetary policy. Zero rates, quantitative easing, large-scale bond purchases. But as the demographic crisis worsens, as growth stays low, as debt rises, the euro's stability will be tested. If investors lose confidence in Europe's ability to manage its debt, the euro could weaken significantly. And if you're holding euros when that happens, your purchasing power declines. Diversifying into dollars, Swiss francs, or even gold protects against that risk. Now, let me be clear. This isn't about Europe collapsing tomorrow. This is about a slow, grinding decline that plays out over decades. Like Japan, the economy doesn't crash. It just stops growing. Opportunities shrink, wages stagnate, debt accumulates, and the next generation inherits a system that's poorer, more constrained, less dynamic than the one before. That's the real tragedy of demographic decline. It's not dramatic. It's just a slow erosion of prosperity. And by the time people realize how serious it is, the damage is already done. Europe's workforce is disappearing. 3 workers per retiree today, 2 by 2040. The math is brutal, and the math is locked in. The policies that might have prevented this needed to happen 30 years ago. Higher fertility rates, immigration-friendly systems, structural reforms. But they didn't happen. And now Europe is facing the consequences. Stagnation in Germany, struggles in France, debt in Italy, and no clear path forward. Because demographic decline doesn't respond to monetary policy. It doesn't respond to fiscal stimulus. It's a structural problem that takes generations to fix. Japan learned this lesson the hard way. They've spent 35 years trying to escape the trap, and they still haven't succeeded. Europe is now entering that same trap, and the pattern says the exit is decades away. If there's an exit at all,